everybody wants income nowadays, and unfortunately term deposits are so low. People have to look at going up the risk curve. To talk about investing for income, we have Dermot Ryan, who is Co-Portfolio Manager Income at AMP Capital. Dermot, some of the challenges facing Australian equities at the moment, what do you reckon?
Some of the challenges, we've actually had a very good run this year, and
up about 23%. Or something.
Yeah, in the order of that, and it's been a very sharp bounce from December. And if you remember the very bad sentiment that's around there, we've had a lot of stimulus in terms of tax cuts, rate cuts, and general spending. But we are at a point where what's happened has been we're not seeing a lot of profit growth or even expected profit growth from companies. What we've seen has been a valuation re-rating. So the price to earnings ratio, which is basically price of the company relative to the profits that they make, has gone up. And stocks have re-rated, but we're yet to see the follow through on profits. And certainly in August reporting season, things were a little bit stagnant, but companies were saying, it's better than it was pre-election. But I think as we go into next year, we're going to have to start to see some of the profits catching up to where the valuations
So we need growth in the economy, and we need companies are doing well, profits go up to justify those share prices. Now, I did touch on the fact that personally, I'm downgrading my expectation for dividends. So what's your outlook for dividends over the next few years if we don't get the kind of growth that you and I are talking about? Do you think dividends are going to be sort of giving into gravity?
Well, I think dividends are ultimately a byproduct of earnings and profits. And so it's not a good idea to pay out more in your dividend than you're making in profit, because you're generally adding debt to your company to do so. So we see, the market in general, the main earnings driver of the whole market has been resources. Now they tend to be uneasy bedfellows for dividend investors, because we all know it's a deep cyclical sector. So at times you make a lot of money and other times you don't. These companies are net cash at the moment, and they're doing a wonderful job of returning cash to shareholders. But I think in time, when you have the two big sectors, as I mentioned before, like banks and miners under these pressures, you actually need to look broader than those sectors to try and find the companies that can really deliver you those good dividends that are defendable in if there is a down cycle in the market.
And so that basically your approach with your portfolio is, it's nice to get the great dividends coming from the banks and the miners, but you are looking broader for those times when the miners stop paying dividends, and they've done that only 3 or 4 years ago.
Yes, yeah.
And the banks, as you say, are under pressure. So you look broader. How many stocks would you have in your portfolio?
So we've run about 25 to 45 stocks, depending on the strategy. So it's pretty concentrated portfolios.
Okay. Is there anything else you'd like to share with us that you think people out there should understand about investing for dividends?
Investing for dividends, I think it's just that the amount of return people get in the long term. If you think about the ASX 200, which is approaching record levels now, if you compare that to the ASX 200 accumulated, you'll generally see over time that the returns you generate, sometimes up to half to 2/3 of those returns can be from the income component. And particularly so when we're in a very lucky country like Australia, where you've got franking credits and that imputation tax return.
And long may stay like
yes.
it. That's Dermot Ryan from AMP Capital.